Hi, this is Jim Francis. In the next few minutes, I'd like to talk a little bit about the M2 Millionaire Matrix. When I created this, it was really taking a combination of different strategies, real estate, stock, business, and asset protection, and putting it into kind of one format that's kind of easy to understand, that most people can grasp as a concept, and then taking that big concept and breaking it into smaller little steps that we can take. If you think about it, if your goal is to get to that millionaire status, and a good friend of mine told me very early that a million's not enough, so I coined the phrase M2. If you're trying to get to that strategy, it's the combination of several strategies that's really going to get you to that level of success. And one of the key things about getting to that level of success is really taking a look at the rates of return that you get in terms of your investments or your investment vehicles. Now, to me, it doesn't matter where you start. It doesn't matter whether you start with real estate or business or the stock market, because when you start with one of them, you end up in the other one anyway. Think about it. If you're doing really well on the real estate side of the fence, you're probably going to do some investing in the stock market. If you're doing well on the stock market side of the fence, you're probably going to dabble in small business or internet or whatever that might be. And all of those really need to have asset protection and taxes kind of as a plan or a strategy, because 1/3 to 1/2 of your wealth is going to come through the proper tax plan. Whether that's taking the maximum in terms of lifestyle deductions or tax deductions, or putting money away for your retirement in a 401k or a self-directed IRA or whatever that might be. One of the major differences, or one of the key things in terms of concepts, is you really have to understand the power of rates of return and time. In fact, I want to start with that before I kind of get into the matrix, because I think it's an important element in discussion with respect to getting into the matrix itself. If we simply take a small amount of money and we use time and the right rate of return, we can have a rich future. In fact, if I was to take $10,000 and over the next 36 years use different rates of return or different interest rates, I can kind of predict where I'm going to be in the next 36 years. Depending if I have a small rate of return or a large rate of return. So I'm going to kind of throw out there 4 different kind of rates of return and then make a rule for us to kind of follow. So we'll start with 10 grand. We're going to put it into the stock market or real estate or whatever the investment vehicle is. It doesn't matter. But we're going to leave it in there for 36 years. We're not going to take any money out. We're going to let it compound over that 36 years. Let's see what the different rates of return would give us. If we have 5% rate of return on an annual basis, it means our 10 grand within 36 years will turn into 58,000. Not a rich future, but we'll at least have some money for our future. If we take that 10 grand and get a little better rate of return, let's say 8% a year, that 10 grand will turn into 135,000. That's not going to put the world on fire, but that 135,000 at least will give us some money for our retirement. If we stick that with the $9,900 we're going to get from Social Security at that point, maybe we can buy a hamburger. I don't know. To me it's just not enough, but at least it gives us an idea, of what those different rates of return get us on that investment of 10 grand. It gets a little more interesting once we get to that 10% number. If we're 10 grand away for 36 years at 10% interest rate on an annual basis, 10% rate of return, we've got $309,000 in our future. Not a great future, but a little bit of a future for us to look forward to, and a little bit of money for us to take care of ourselves, maybe rather than having to work that second job when we turn 65. Where it gets really interesting and where the rule really comes into play is when we get to that 15% range. If you can get 15% on your money every year, you put that $10,000 away for 36 years, literally that can turn into $1.5 million. Now that's a number that most of us can exist on. In fact, I saw an article just recently that says the average American is going to need to have $1.2 million in retirement at age 65 to kind of look after themselves. So at least this will get us to that point where we'll be looked after in our future. Now, here's the key. It's that 15% a year. And the hard question I'll get to ask a lot of people is, are you making 15% a year? And most people say no. And the reason they do that is because they're using the wrong plan. They have a plan that kind of goes, I'm going to buy and hold stock over a period of time, or I'm going to give my money into a mutual fund or trust it to a financial advisor and let them look after it. Now there's a problem with that plan, and I've been a financial advisor and had my securities license. In fact, I was a supervising principal at one point, which meant I supervised other individuals. The piece there is, those guys have a buy and hold plan. They have a buy and hold. They don't have let's make money in a down market, let's make money in a sideways market. They don't have those kinds of strategies at their beck and command to use. So what we need to do is we need to have a better plan than a buy and hold plan. We need to make sure that we're making that 15% a year, which means we need to take a look at other strategies. Some of those other strategies might be tax liens or real estate, or credit spreads or seasonal patterns or whatever it might be. But we got to get different patterns or different strategies into play to get to that 15% a year, to get to that 1.5. Now let me suggest something else to you. That 15% a year is just the beginning. If we really know what we're doing, we can get much better than that. And if we get much better than that, we can actually have a much richer future and get to the gold and find the treasure. I kind of found the treasure map. What I mean by the treasure map is, I spent $81,000 in books, tapes, and education, and pretty much have gone to everybody's course, whether it's business, real estate, or the stock market, or asset protection, or taxes. As part of that, I kind of grouped strategies into kind of a system, and I call it the Millionaire Matrix. When I say the Millionaire Matrix, it really focuses on the fundamentals of the stock market, real estate, and business. But then it takes a step further and says, hey, listen, it's not enough just to have those areas working for you. You have to kind of have the right perspective in terms of cash flow and growth and speculation and taxes and asset protection. So, this to me is the Millionaire Matrix system. I'm going to fill it in for you real quick. Obviously I don't have a chance to talk about each of these strategies because literally every single one of those labels up there is a strategy that we could talk about in terms of cash flow or growth or speculation or taxes or asset protection or whatever that might be. And I quite often get asked, hey, listen, can you kind of give me that whole chart? And if you want to pick up this chart, you can. If you drop by two of my websites, one is www.m2book.com, or you drop by www.m2spread.com, you can take a look at these different strategies, whether they're cash flow strategies, and also pick up that matrix itself. What I'm going to focus on in the next few minutes is really talking about, the cash flow strategy for the stock market side of the fence, because this is one of the areas that I think you really need to focus on. If you think about it, in 2008, most people got hurt in the stock market and lost somewhere between 30 and 40% of their account. Could they have used a different strategy which could have made them money during the same period of time? And the answer to that is yes. The reason they got hurt was, in their 401ks or their IRAs or their accounts, they had a buy and hold strategy. And a buy and hold strategy doesn't work in a down market no matter how much you try. So you've got to develop other strategies that are neutral strategies, that are sideways strategies, or down strategies. And that's really where a number of these strategies come into play. Now, I don't have a chance to go over covered calls, which is a great strategy I really believe in. I actually traded it for a long time. We're going to seasonal trades, for example, the Christmas effect, where during a 6-week period of time, the market tends to go up somewhere between 9 and 10%. Or a seasonal pattern like the best 6 months, where during that best 6 months you'd made more money than you invested in the other 6 months, Kind of talked about a little bit of that in my www.m2book area, if you want to drop by and take a look at that. But I want to talk a little bit about the top one called credit spreads. Credit spreads is an outstanding strategy. When I say outstanding strategy, it's a strategy where literally you can go to the stock market every single month and pull out cash. I like to call it the ATM machine, because literally, if you know what you're doing, if you follow the rules, if you follow the strategies, you can earn between 8 and 12% on your money within a 30 to 45 day period every single month. No guarantee of success. I mean, options have risk. Past performance doesn't equal future performance. But it has a high probability of winning. In fact, my personal experience, having done credit spreads for just a little more than 3 odd years now, is that you win 11 times out of 12, 11 months out of 12 during the course of a year. And if you can minimize that 1 month that you're losing, that can be a great rate of return. If you're making 8 to 12% on your money, that in a 30, 45 day period, leads to a great cash flow strategy, but can also lead to a great growth strategy. Now, I don't have a chance to go over credit spreads in great detail in this section, and this is really to introduce the Millionaire Matrix, but what I would suggest that you might want to do is maybe drop by one of my websites, one in particular called m2spread.com. m2spread.com goes into the credit spread strategy in more depth and gives you some insights with respect to that. This is Jim Francis, saying so long for now, and I'll see you next time.